Hi there, everyone. I am Lens Beniz Kayubit, one of the accounts executive at Pearl Lemon. So for today's video, we are going to continue discussing valuation process. And this is part 1.3, and I guess it is the last part in the discussion of understanding the business. In analyzing historical information, focus is afforded rather in looking at quality of earnings. Quality of earnings analysis pertain to the detailed review of financial statements and accompanying notes to access sustainability of company performance and validate accuracy of financial information versus economic reality. During the analysis, transactions that are non-recurring such as financial impact of litigation settlements, temporary tax reliefs, or gain or losses on sales of non-operating assets might not be adjusted to arrive at the performance of the firm's core business. Quality of earnings analysis also compared net income against operating cash flow to make sure reported earnings are actually realizable to cash and are not padded through significant accrual entries. Typical observations that analysts can derive from financial statements are listed below. First line item is revenues and gain, and these are the possible observations. The first one is early recognition of revenues. Examples is build and hold sales recognition prior to installation, and acceptance of customers. So what is the possible interpretation? Then it means that there is accelerated revenues recognition, improves income, and can be used to hide declining performance. Second possible observation is inclusion of non-operating income or gains as part of operating income. What does possible interpretation? Non-recurring gains that do not relate to operating performance may hide declining performance. Next line item are expenses and losses. So here we have three possible observations. Let's start. The first one is recognition of too high or too little reserves. Example of that is restructuring or bad debt. So what is the possible interpretation of that? Um, I guess there are too little reserves may improve current year income but might affect the future income. Next one is deferral of expenses such as customer acquisition or product development cost by capitalization. The possible interpretation is it may improve current income but will reduce future income. And also it may hide declining performance. Next and last possible observation is aggressive assumptions such as long useful lives, lower asset impairment, high assumed discount rate for pension liabilities, or high expected return on planned assets. What is the possible interpretation? Aggressive estimates may imply that there are steps taken to improve the current year income. Sudden changes in estimates may indicate masking of potential problems in operating performance. Next line item is the balance sheet items, and it has one possible observation, and it is off balance sheet financing like leasing or securitizing receivables. So the possible interpretation of that is there are assets and liabilities may be reflected or they may be not fairly reflected rather. Next and last is operating cash flows. So the possible observation is that increase in bank overdraft as operating cash flows. The possible interpretation is potential artificial inflation in operating cash flow. This is the end of discussing understanding the business. Thank you for listening. See you on the next video.